Well, yesterday was busy in the media space. Disney joined Peacock and Max in upping prices on its streaming service, and Netflix reported very strong results. Joining me now with more is David Joyce, Senior Media Analyst at Seaport Research Partners. David, welcome to the show. It's good to see you this morning, and no shortage of things for us to talk to. So let's dive right in here. For consumers, viewers who are watching, what can they expect to pay these days for a streaming service?
It varies by service, and it usually goes up right before your favorite new content or new sequel or movie release is going to come out. But it really does vary, and it varies by bundling opportunities. If you're in the Disney Plus world, the rack rates do seem expensive, but then if you layer on the ESPN Plus and Hulu and even Hulu Live, then you can be getting up to about $100. But if you're just getting the ad-supported tier on Netflix, that's only $6.99. You do have a few ads then, but it really ranges. But basically, these companies have been raising prices roughly every year for the past few years by $1 or $2.
You mentioned Netflix there, David. I do want to turn to that. That stock, of course, higher pre-market, very volatile. We have seen shares of Netflix in the wake of these earnings reports over the years, but its ad tier actually seen a jump of 34% in terms of subscribers. What was behind that?
That is still part of the process they put in place last year to get people to pay for their sharing instead of all of the password sharing. The reason they came out with an ad tier is to come out with a very low price point that would get people to at least be paying something and still being engaged. And then that sets up a base for them to drive advertising for the long term. So it's a deceleration from the last couple quarters, but it's still off a fairly small base, but it's getting pretty sizable now. We think it's a little over 30 million of their subscribers now are on these ad tiers.
Interesting. So churn, of course, has always been a challenge for some of these streaming services, many of which really came to market after the coronavirus pandemic. Are there certain services, David, that are emerging to you as stickier than others in terms of price point and content?
It seems like Netflix and Disney Plus are the stickiest. Netflix because of its price point and because it has a great array of content and it's got a very easy user interface. Disney Plus has been very sticky, particularly for families with younger children, because a lot of content's on there that they've even been taking off some of their linear channels. So those are the two services that do have the lowest churn, but I think Netflix still wins out on that metric.
Interesting. Well, companies, of course, like Disney, as we've been covering, raising prices. In terms of a resilient consumer, any expectations for how that might impact streaming services heading into the holidays?
It should do very little in terms of churn because there's so much content that people are essentially getting used to and relying on here. It really would be a de minimis loss of customers. But I do still expect the subscribers to grow. For Disney, for example, you'll have Inside Out 2 becoming available on their service, and also they've got the new a new Marvel series is on there. So you definitely want to, I think the consumers will be holding on to their services. They'll grumble, but in the grand scheme of things, if you're paying a $17 a month tier and you're getting an hour, on average, people are using streaming services about 2 hours a day. That's very cheap entertainment.
We've seen linear decelerate. There is so much focus on streaming these days, even though it's been a challenging economic environment in some cases for consumers to pay for these services and for the streaming model to really make sense. Do you see that changing?
We think that there will continue to be a decline in linear subscribers. I don't think it'll be as bad as the 8% losses on average year over year. I think it'll mitigate somewhat. But broadly, there are broad macro reasons why that would happen. Younger consumers who are starting to pay on their own are going to more than likely choose to pay for the streaming services because they can access that on multiple devices. But On the other hand, one of the things that's starting to mitigate the issue is of the linear losses is that these streaming services have increased their prices so much that it's not such an obvious cost savings to leave the pay TV bundle. If you want to get the array of content that you have to where you have to buy, Max and Netflix and Disney, it still offers the consumer a lot of choice. But I think that on the margin, it might keep the losses on the linear side from getting worse.
David Joyce, great to get your take, of course, heading into the weekend. He's a senior media analyst at Seaport Research Partners.